Hi, good morning, Anirudh, Abhishek. Hi, Chaitanya, Dheeraj, Dipalok. Welcome, Yash. Hi, Ishpuri, Kamlesh Mehta, Kartikeyan, Madhuri, Makran, Mamta, Nikhil, Piyush, Prashant Doshi, Rajeshri, Rakesh, Kalra, Rashmi, Sachin, Samir Doshi, Suchit Saxena. Welcome. Welcome, everyone. Super. All right, let's get started. Okay. And we are going to move into the third part of this week on liquidity. Okay. And so, so we have looked at how liquidity influences markets. We have looked at the various tools that are available with Reserve Bank of India in terms of infusing liquidity within the system. And today we are going to see the linkage between liquidity and equity markets. Okay. So, where should I start? So, there are few things that many a times confuses almost every investor. Okay. कि ऐसा होता है कि there is definitely bad news everywhere. Inflation चल रहा है. There is fear of war, weak global economy, layoffs हो रहा है, negative headlines आ रहे daily. But still the markets continue moving up. ऐसा होता है. कभी कभी उसका ऑपोजिट भी होता है. Like sometimes the company results are decent, economy looks stable, news flow is largely okay, but markets still fall very sharply. Why does it happen? Is the market becoming irrational, or are we missing something deeper underneath? What do you think? Please write in the chat box. कि इस situation में, when things are, headlines are fine, markets are dropping, or when headlines are weak, markets are rising. What do you think is happening? Has the markets become irrational, or are we missing something big within the system? Okay. Karthikeyan writes, maybe some operators have insider information. Okay. Profit booking. Okay. This is where most people misunderstand markets many times. We think markets move mainly because of news, GDP, earnings, election results, and so on. But let me tell you something which goes beyond this. Many times, markets rise not because fundamentals have improved. They rise because the money is abundant. And when money becomes easily available within the system, behavior changes and people become very aggressive. Risk-taking ability increases, valuations expand, and every correction is looked at as an opportunity for the rest of the people. Now let's think carefully. Can even the best businesses rally continuously? Is it possible? Can even the best business prices rally continuously if nobody has money to buy it? The answer is no, which means even the best of the companies, the prices doesn't go up every day. They might be giving the best of the performance quarter on quarter for the last 5 years, 10 years, 15 years, but still the prices do not go up every day, which means there is one invisible force which quietly controls the risk appetite, the market momentum, the valuations, the speculative behavior, and even investor confidence. And we all know this is what we are discussing this week. That invisible force is liquidity. And smart money tracks liquidity far more seriously than retail investors realize. Because liquidity changes markets before headlines change. So आज वही देखेंगे. So today it's about understanding that hidden force behind every market movement. Why markets sometimes ignore bad news completely, and why the same market suddenly become fragile when liquidity disappears. Because once we understand this, we will stop asking कि boss हो क्या रहा है? Is the market becoming irrational? Okay? Chalo, let's get started. Give me just 1 minute and I'm going to share my presentation deck. Hmm. Is it visible? Presentation is visible. Okay, thank you, Karthikeyan. Okay. So, how liquidity drives the market behavior? Okay. Why prices move when everything else says ki no, prices shouldn't move. The headlines are telling us something else, but still the prices move. So the news is high inflation, war fears, weak economy, global layoffs, and still the markets are moving. That's an illusion. The uncomfortable reality of modern market. Bad news is everywhere, yet the markets continue to rise. Okay. And so that is the kind of situation that we are going to figure out. Ki boss, what is that hidden force? What is that missing variable in this entire scheme of things? So most investors believe that markets moves solely on information. This is incomplete belief. Markets move on availability of money. There are certain necessary conditions, and then there is a sufficient condition. Availability of money is a sufficient condition. Prices don't rise only because businesses improve. They rise because money is chasing to buy that asset. And what is that? What are the various things which actually moves that? What are the actors? The FIIs, the DIIs, the SIP money, the borrowing becomes easier. So all of this results into a continuous asset demand. People see a stock price rising, but they fail to ask who is buying aggressively underneath. Markets rise when buying pressure becomes structurally stronger than the fear which is pushing down the prices lower. So, what has happened before and what is happening now? So, during the COVID times, we all remember we were in the worst of the crisis and a lot of fear approached. Even the weak companies rallied aggressively during that time. Why? A pure liquidity flood overpowered the fundamental scrutiny. There was a lot of shift in behavior that was noticed. Risk appetites rose. Abundant money came into the system. The confidence started to go up. People's behavior changed and prices started to move higher. So, what is the bad news paradox? Why do markets ignore bad data? Because excess money is always actively searching for returns. कभी कभी हम लोग बोलते हैं ना पी बहुत एक्सपैंड हो गया फिर भी मार्केट गिर नहीं रहा है क्यों because there is abundant liquidity. Every dip in the market is looked at as a buying opportunity. And this liquidity cushion absorbs all kind of shocks. Excess liquidity acts as a shock absorber. So on the news front, if there is positive news and the liquidity is strong, then we are in an euphoria, which we are going to get into a mother of all rallies, unprecedented rally. Bad news, remember, do not kill the market immediately, but liquidity withdrawal kills the market immediately. Okay. So valuations, expansion. Liquidity can inflate valuations far beyond the fundamental comfort. जो कंपनी पहले 12 के मल्टीपल पे चल रहा था वो 15 भी हो सकता है 20 भी हो सकता है 25 भी हो सकता है sometimes earnings don't improve much yet stocks rise sharply and these multiples expand because of abundant liquidity. More money chasing fewer quality assets inevitably inflates the cost of those assets. Now there could be a getting into a danger zone. Okay. There could be getting into a danger zone. Liquidity driven rallies feel the safest near the absolute top. But extreme confidence and microscopic corrections are exactly when the fragility starts to build silently. High confidence does not equal low risk. The risk might be there, but this excessive liquidity has given rise to a very fragile overconfidence, high confidence zone. Okay. In this perceived safety, it is not safe, it is a perceived safety. Everyone making money, corrections are small, confidence is extreme. Every Tom, Dick, and Harry is giving advice. In this silent fragility zone, they are compressed, erratic, hidden dangers. This is the time the worst of the crisis can hit us. Then there could be a withdrawal shock when this excess liquidity is taken away. जब 2008 में the global financial crisis happened, started off in the Western economies, Western markets, Federal Reserve pumped European Central Bank, Bank of Japan, everybody pumped a lot of liquidity into the system. And it took a long time for them to take a decision to withdraw that money. Because if you are pumping in a lot of excess liquidity in the system and then suddenly take a decision to withdraw, it's going to be a catastrophic. When the liquidity reverses, the markets definitely invert. Valuation starts will compress fast. Panic will rise quickly because nobody will start to think that this situation can reverse. Okay. And this liquidity withdrawal has to be extremely well planned out by the central banks. It has to be planned out over a long period of time. Okay. It cannot be immediate. You can pump in money immediately, but when you're deciding to pull out money, it has to be much, much longer time. So what are the signals of easy liquidity? Extreme overconfidence. When you see extreme overconfidence, high leverage adoption, momentum chasing, unrelenting IPO frenzy, these are definite signs of excessive liquidity and overconfidence. Liquidity conditions are cushioning the risk sentiment. Liquidity is driven, multiple expansion is happening. Liquidity is overpowering near-term fundamental concerns. These are the higher level conversations that we keep suggesting that you should use. So the market fundamentals and optimism is driven by the fuel, which is the excess liquidity. Okay. You might have the best of the fundamentals. These are all necessary conditions, but not sufficient condition. Markets don't just need optimism, they need liquidity. And liquidity comes from the banking system. So interest rates and liquidity are the two clear fuels which drives the market. Remember, if there is a news, it will change the emotion, good or bad news. Liquidity will change the market behavior itself. All right. All the best, everyone. Have a great day ahead. And I'll see you tomorrow exactly at 10:10. All the best. Take care and grow your AUM very fast. Bye-bye. Take care.